About a year ago now, we started our How to Build a Portfolio from Scratch series here on the channel. With this time having gone by, what I want to do in this video today is do basically a complete one-year review of what's happened in this series. We're going to look at what worked. We're going to look at what didn't work in the series. We're going to look at what investments are currently in our portfolio, talk a little bit about some of the changes that we've made, and we're going to then take a moment and compare the portfolio to the markets in general and see, how we fared in that regard. Quick review for those of you who are new to the channel or aren't familiar with the series. In May of 2021, we embarked on this project where we put together a portfolio. In total, we injected $40,000 into the portfolio, but we split it into two different camps. So we had $20,000 that went into a Quest Trade account. That is a more aggressive mandate in the account. And we also built a $20,000 portfolio in Wealth Simple, which had a more moderate, a more balanced mandate to it. The main goal there, the main reason we did that was because we wanted to sort of compare, a lot of our viewers, some are just starting, some of them are more aggressive, some of them are more mature and may have a more moderate objective in mind. So this was kind of an opportunity to show you how different types of portfolios will react during different times. And certainly during the last year, we've had a chance to sort of see how that's worked out. We're going to look at that in the video here. We put $20,000 into each account, and then we've been adding $1,000 a month in the time since then. If you did want to go back before you watch the video or after you watch the video and review the entire series, I will put a link here that you can look at to sort of go back to the playlist and pick and choose so you can sort of get a better context right from the start. I do want to say a quick word about benchmarks because it's very, very common that a portfolio, the rates of return are measured against an index, for example, the S&P 500 or the NASDAQ or the TSX. And in many cases that is appropriate. However, there are also lots of cases where it's not appropriate. And just let me explain for a moment. Your objectives are personal to you. So however you have constructed your portfolio for your own needs, for your family needs, very rarely would you have something that exactly mirrors one of those indices. And so if you have something that is different, say, I'll just use the S&P 500 or the TSX as an example. If you have something that is not as exactly like that, there will be periods where you overperform that index. There'll be periods where you underperform that index. At the end of the day, you need to have a portfolio that meets your needs. And the paths can be quite different. I'm going to give kind of a stark example here. A common measurement, a common benchmark or milestone that people use are the S&P 500, the S&P 500 index, which is 500 of the largest U.S. traded companies. If we look at what's happened over the last number of years, I'm just going to pick here a fund that a lot of people are familiar with, which is the ARK Innovation Fund. And this is run by Cathie Wood. And I'm not picking on her here, and you'll understand this, but the fund has not done well lately. So if you are a growth-oriented investor, and if you kind of threw out all the old balanced portfolio rules about a year or so ago, if we look at what's happened in the last 12 months, the S&P 500 is down in value. It's down around 10, almost 11% as of the day I'm filming this video. But when you look at a very focused fund like the ARK fund, it's down over 66% in that same time period. That's something that you can get into trouble with. If you're comparing yourself to a fund like that or to an index, you can see how much of a divergence there can be in a really short time period. Now, if we look back to 2020, so not that long ago, and we compare the exact same two investments, we're going to see the exact opposite. We're going to see the ARK fund up about 170% in that time period in 2020. We're going to see the S&P 500 up about 17%. And even 17% is normally not a bad rate of return for a calendar year. But when we came out of COVID, we saw such a sharp increase in the markets that there were a lot of people just discounting the good old-fashioned indices like the S&P, like the TSX, like even the Dow Jones Industrials, for example, and saying all your money should be riding on a more aggressive investment like ARK. So this is kind of a quick example, just as an aside to say, make sure that when you're comparing your portfolio, or if we're looking at the portfolios we're running here, what index or what measurement is appropriate to use against those. If we look at these two investments, the ARK and the S&P, just to complete this topic, if we go back to 2020 all the way through to today, we can see that if you would have bought and hold in January of 2020 and run through to today, you would in fact have made more money with the S&P 500. $10,000 invested then would be worth around $11,300 right now, whereas with the ARK Innovation Fund, it would be worth about $7,500. More importantly, you're going to see the huge difference in the way that the path that these two investments have taken. If we go all the way back to 2014, which is when the ARC fund was launched, dramatically different path, as you can see. And yet when you look at the rate of return during that time period, they're essentially, for all intents and purposes, they've come out exactly the same. As an investor, when you're constructing your portfolio, do you want that more exciting ride where perhaps you can ride it up, and if you believe in timing the markets to a certain extent, you maybe will take some profits at a certain point. You can definitely come out ahead that way. Be aware of what you're looking at there. Now, in the case of measuring our portfolio performance, to try and keep it as clear as possible, we're going to measure it against the Toronto Stock Exchange, the TSX. For those of here in Canada, we're going to look at the S&P 500. We're going to look at the NASDAQ. In addition, I'm going to compare it with 3 iShares funds. One is the iShares Core MSCI All Country World excluding Canada fund, and that will give us a comparison of sort of what's been happening around the world in the last year or so. We're also going to compare it to the iShares Core Growth ETF, or XGROW, and also the iShares Core Balanced ETF, or XBAL. And these are some pretty popular funds here in Canada. So they're, wherever you fall, whatever basket you fall into, that will give you at least some tool to measure your investment against. Now, when we look at these investments over the last year, the top performing index has been the Toronto Stock Exchange, which is down 2.61%. Most people understand that virtually all markets have been down over the last little while, but the S&P, the TSX up down about 2.6%, all the way down to the NASDAQ down about 18.5%, as you know, from a year ago today. The S&P 500 down about 11%. The world index, the XAW, down just shy of 10%. And then these 2 iShares portfolios, the growth fund down about 9.2%, and the balanced fund down just under 10%. So I think of this range here, it is valid to say, okay, in this experiment we've been doing with the portfolios, where do we fall within that range there? Or have we done better, or have we done worse? Quick note here. This is really critical if you are going to be a follower of our channel here. Brandon, about a week ago, put out a video just saying he's taking a break from producing YouTube videos here. And there's a number of reasons. He explained them on the video to do that. There is a comment that came out in response to his announcement there, and I'll just quickly read it here. It comes from My Public YouTube, and he or she says, right timing. All of these show-off content creators have nothing to say anymore. During a slowdown when they have nothing to say and can't show off their own red portfolios like they showed until last year to mislead people into claiming how easy it was to make money in the stock market. And that cash is trash and that saving is losing. Now people like him are selling and saving that money in cash. I wanted to respond briefly to this comment because the whole purpose of what we're doing here is exactly the opposite of that. First of all, we're not going to take claim for calls that we make that are good and then discount or ignore or delete claims that we make that aren't good. The whole purpose here is to go through this experience in quite a bit of detail to help people who may want to start and build their own portfolio. So we are never going to just discount the calls that we make that don't go in our favor. That would be doing a disservice to all of you. Promise to you here, that's never going to happen on this channel. So I hope that My Public YouTube person who left that comment will take some solace, and maybe the fact that we're doing this video today will sort of give an example of that, because we're going to talk about the performance of our 2 portfolios over the last year. And gee, do I wish I could sit here a year later and say the funds are up tremendously? Well, part of me says yes, but part of me says, well, that's not something realistically you can expect in a year, especially the year that we've gone through right now as part of managing a portfolio. Bottom line, over the year now, we put between the 2 portfolios $70,000 combined with the initial deposits and the contributions as we go along in the month. As of today, as of filming this, the current balance is $67,185. So that equates into a reduction in the value of $2,814.87. That equates to 4.02% over that 1-year time period. When we look at that in the two different silos, so we have the balanced portfolio or the moderate portfolio, that's done with Wealthsimple. And if we look at that today, we have 34,459. So the decline in that fund has been $540, which equates to a 2% downside since the beginning. Now, on the flip side to that, we look at the more aggressive portfolio is with Questrade, and the balance on that as of today is $32,725, or a loss of $2,274.51. That in percentage terms, is a 6.5% since inception, so over the last year. One of the objectives of the portfolio, one of the reasons, in fact, the reason that we split into two different portfolios was to demonstrate moderate versus aggressive. And even if we look back over the last year, I'm going to compare these sort of head to head here, but we see the blue line in this chart represents Wealthsimple, and the orange line is Questrade. And you can see that during this sort of race over the last 12 months, you can see that each of those has led, if you will, at any particular point in time. Interestingly, if we look at the S&P 500 on this accompanying chart here, in red, I've got on the left-hand side here a time period where the S&P 500 rose. And when we see that, and that's roughly October, November of 2021, and we compare that with the portfolios that we're running here, we'll say during that same time period, the orange line accelerated and outpaced the balanced portfolio of Wealthsimple. That's what you'd expect when the markets are going up, the equity markets are rising. You would expect that growth type of portfolio to pass the more conservative portfolio. In contrast, when we look at the next little period of time, there was a bit of a flat sort of trading within a range on the S&P 500. During that time, things sort of settled in, and there was a bit of a more and more neck and neck with these two portfolios. Then if we look at year to date in 2022, obviously the S&P 500 has retraced significantly. And when we look at that, we will also see that the Wealthsimple portfolio has outpaced the Questrade portfolio during that time. And this is really no big surprise. When the whole concept of, when you manage money, this risk versus reward scenario, and even in this 1 year snapshot, you see that at play. Now, certainly if we look as the years go by and you stretch that line out, we'll see that even in more stark circumstances or stark demonstration. But right now, for all we have is a year. So that sort of goes to show that that's exactly what you'd expect going into a portfolio. And on that note, you should expect certain things when you go into a portfolio. And in the short term, anything can happen. But if you're managing money, don't just understand the path that you're getting onto. Again, that's to be successful in investing. That's the mindset that you should have going in. I'm going to talk about a few sort of notable things that have happened to the portfolio, or just bringing you up to date on the portfolio overall. First of all, we would say that the portfolio is now, I would call it fully built up. So we started a year ago. Generally, when you inject a cash amount into the portfolios, like we did here, 40,000 altogether between the two different silos, it's very rare you would take that all, put it into the markets on day one, and then go along your merry way. Generally, you're going to work that in over a period of weeks or months. And so now that 12 months have gone by, we definitely have done that. We've actually built it up to what I would call a full position. We have exposure to all the sectors with the exception of materials. At this particular point in time, we don't have anything in materials. That's pretty typical of what you would see in a portfolio where you have a broad range of exposure, or at least I hope that's what you would see between all the different sectors. When we look at the transactions during the last year, if you go back and look at the series of videos, I think there's 11 previous videos to this one, you will see the various trades that we made, the logic behind them along the way. We've bought a number of stocks on the dips. We've been dollar cost averaging, as I've said, into the portfolio. And we have actually sold on a couple of occasions, most notably later in 2021, to take advantage of the crystallization of some capital losses that we took ourselves out of the position. We're now back in those positions, but we were out of them for a long enough time that those losses are not superficial. So now future gains we'll be able to use off from a tax perspective there. Both portfolios do have an element of fixed income in them. Normally in times like this that we're seeing right now, with the markets so volatile, with the equity markets selling off, generally, historically, you're going to see fixed income counter that. And that's one of the main reasons why you have bonds in the portfolio. And as we're going to see in just a few minutes, that hasn't happened during this recent sell-off. And I'm going to talk a little bit more about that in a few minutes. Both of the portfolios, as we just looked at, are down. 2% in the moderate portfolio, 6.5% in the more aggressive portfolio. Quite bluntly, we're okay with that. Given what's happened, the portfolios have behaved in a manner that we would have hoped for, that we would have expected. One of the benefits that we've had is that The fact that we've been contributing on a monthly basis, that will help because on the down months, we're not going to have so much money subject to those downs, but also it's given us some cash flow to add to some of the companies that we believe are going to be long-term performers in the years to come. In many cases, if you are managing a portfolio and we have a lot of students in our academy who every paycheck or once a month they're putting money into a portfolio. This is an example of how, in our case here, there's about $67,000 roughly that we've accumulated in the portfolio. Yes, the value is down on a percentage basis, but in many cases, this is money that people wouldn't have if they didn't have that forced discipline savings plan. So if you are in a situation where you're contemplating investing or you've started investing, I can't overemphasize how important it is to have that discipline, invest the money as you go along. And then even if the markets don't work phenomenally in your favor, at least you're going to still end up, the act of putting that money into the investments, unless you're buying something really bizarre that's literally going to disappear or drop 80, 90%, you'll come out ahead in that regard. So that's really critical when it comes to managing a portfolio. Let's look at the holdings of the portfolios now. And overall, if we combine the Wealthsimple and the Questrade, there's 31 holdings that we've built up right now. The gains and the losses over the last 12 months are split pretty much down the middle. There's 16 investments that have gone up and 15 that have gone down at varying degrees, which we'll look at in just a second. I will say that's probably not typical of what you would see in a portfolio. Generally, because in general, the markets move up more than they move down in any given time period. And let's just use a year as an example. In most years, of 31 names, you would expect maybe 25 or so to have risen in value and say 5 or 6 to have declined. Maybe a little bit different ratio than that, but it's rare that you're going to have anything that is exactly split down the middle as we seem to have had here. It is important. If you have a portfolio where everything is going up or everything is going down, that is a problem because that means you aren't properly diversified. And what we've tried to illustrate in the portfolio here is having different types of investments will help ride out the difficult times that we're going out right here. Of the companies that we own, the gains, Suncor is the biggest leader at a 32% gain so far. Alibaba is our biggest loser so far on the year at 49.5% down. Now, quick note, when you're looking at the sheet I'm putting on the screen here, it does show Alibaba with a decline of 4.07%. Now the gain or the loss on that, as I say, is actually higher than that. But in December of 2021, we sold the position out of Alibaba to crystallize those losses, the capital losses, which we can use again against capital gains in the future. So that's, it says 4% on the sheet, that's what it's down since we repurchased it earlier in 2022. But overall, it's our biggest loss at 49%. From a percentage perspective, our largest single holding is Toronto Dominion Bank, which represents about 6.5% of the portfolio. And our smallest holding is the Canadian Apartment Property REIT, which comes in at 1.36% of the portfolio overall. A quick comment on the diversification or the weightings. We like to think that generally 2.5%, 3%, maybe 4% will be what I would call a neutral weighting in the portfolio. If you're going to spread your eggs between different baskets, you're not going to have 20% of your portfolio in any one company. I personally don't see a big value in having 0.25% of your portfolio in any individual stock. We want to have enough of a weighting that each investment plays a purpose and actually can have a meaningful effect on the portfolio. But as you can see here, where we've split between sort of the 1.5% and the 6% range, that is a range that you would expect to see for the portfolios we're managing. At least you'd expect to see the weightings of each individual holding somewhere along those lines. Now, I will make an exception for an ETF. If you happen to own an ETF, well, an ETF, because of its diversification, may inherently have play a larger role in your portfolio. But for individual securities, that's what we would be looking at. If we look specifically at the Questrade account now, there's 14 companies in the portfolio. This is the more aggressive of the two mandates that we have, half up, half down. If you flip over and look at the Wealthsimple account, the particulars of that, 19 companies in the portfolio, 8 of those are negative on the year, 11 of those are up. With the more aggressive portfolio, you're going to expect to see a bigger swing from the top gainer to the top loser than you would in the moderate portfolio. That's the range of returns you're going to get. Again, coming down to expectations, you should expect to see a larger variance there, and that's exactly what we've seen in the 1 year that we've looked at here. From an asset allocation perspective, from the top down, we have about almost 9.5% of the portfolio in cash at this moment. About 85% of the portfolio is in equities, and about 6% is in fixed income. From a currency perspective, we have 43% of the portfolio in Canadian denominated assets and 57% in US dollars. And then you can kind of have a look here at the sector breakdown. And the largest particular sector that we have holdings in right now is infotech, about 14%. Then next we have consumer staples and financials at about 12%. And then, most other asset classes or most other sectors also have a reasonable breakdown there. This is sort of an example. I sort of alluded to this earlier, but I like to think that when you spread your investments out between different types of investments, you're going to benefit from, it's going to hurt you if one or two of them goes up to a large extent, like we saw in the tech sector, going back a year and a half now. But also we're going to see some protection on the downside when inevitably we're going to see that, the rotation on those sectors there. With this particular portfolio, what over the year, what would I say are our wins? What are our mistakes that we made in the portfolio? It's hard to say because 1 year isn't a huge, long time frame. I'm kind of reminded that building a portfolio and investing is a marathon, not a sprint. So it's really hard to make any big conclusions in this. Clearly, if we could have avoided buying some of the companies that went down, that would have been great. We did our analysis on each of them. We felt, given the different factors that we look at, we were comfortable owning them. We're always of the mindset that you buy something based on the evaluation you do, it could go down, and that's exactly what we've seen here. Will some of the bigger bets that we've taken pay off? I mean, time will tell us. So you look at Disney down 40%-ish, Adobe I mentioned down around 30%, 28%, something like that. I guess a good question is, do we hold these or do we sell them? And this is now we're getting into sort of the real nuts and bolts of managing a portfolio, because building it up and making purchases is one thing, but the tougher decision, I think, is whether you sell or whether you trim. To bring you up to speed on our thoughts right now, at this point, we're not expecting that we're going to sell or liquidate any of the positions that we have. When we look at Adobe, we look at Disney, we look at the other ones that have declined in value. We don't expect these are just going to disappear, like a lot of companies or a lot of investments are these days. So if anything, we'll be adding to them as time goes by here. But for the time being, we're content holding the companies that we do. The biggest win, I would say, that we had over the last 12 months is we avoided the temptation, the FOMO of the meme stocks and the cryptocurrencies, and all the hype that surrounds always in this industry. So many different investments, and it wasn't a hard decision for us because that's just not our belief that to be a successful long-term investor, those are the types of investments in general that you would avoid. But we're humans, and did we talk about them? Every time we talk about the portfolio and what we should be doing, we're always, it's always part of the discussion, but we haven't gotten to the point yet where, and probably won't get to the point where we're saying dipping our toes into there, or if we did, it would be a very, very small amount. So a positive thing, a win for us in the portfolio management over the last year is that we have avoided all of those assets pretty much that you're seeing today with those tremendous drops in value. So we're pretty happy about that. Our logical question, so what do we do now? How should we manage the portfolios going forward? Well, we're a year in. The mandates are going to stay the same. We're going to continue to manage an aggressive portfolio. We're going to continue to manage a moderate portfolio. In other words, we're just kind of going to stick with the plan. The goal here, one of the major goals, is to provide a real life, real money illustration or demonstration of how these works, of how these types of portfolio work. And so we are not going to change that. There are two generations here. There's Brandon, who's in his late 20s. There's me, 60 in a few days. Different generations, generally different mindsets. And we know a lot of our viewers are younger. We have about a half split between 35 and under and 35 and older. So probably for someone in their 40s or 50s, a more moderate stance approach is more appropriate. And certainly for a younger investor, a more aggressive approach could certainly be understood. The goal continuing going forward is with those two mandates to make sure that we can help and demonstrate what you can expect when you see those different behaviors of the portfolios. The key for us and for everybody is just to have a plan. Make sure that when you're putting your money down on any type of investment, you have that plan. You understand what you're getting into going from the start. Because if you don't have a plan, you're setting yourself up for some sort of failure there, I would think. The question I would have is, were we too heavy into equities? As we pointed out, we're about 85% into equities right now. We would say no. Sure. When the markets took their recent decline, would it have been nicer to have been in fewer equities? Well, sure, absolutely. However, when we look at the mandate, we look at the purpose or the goal of building this portfolio. These are growth accounts, one more aggressive than other, but these aren't money putting away for some short-term need. They're long-term horizons. So we believe that the majority of the money should be invested in the equity markets because that's where returns have come. So I don't, we feel that we're okay with holding the higher weighting in equities. We are continuing, as we speak here, to buy into some of the companies that we want to hold for the longer term that have declined in value. We're seeing, picking up some extra dividends. We're employing the money that we're bringing in on a monthly basis, and that's one of the if you're running your portfolio for yourself, what's one of the joys of having a pre-authorized contribution where every week or every month or whatever the time frame is, you have money going into the portfolio. This is an example of where you can continue to purchase if you have the tolerance for it, and you're not just stuck with no cash. I mean, we're going to have cash coming in on a monthly basis that we're going to be able to use when we see opportunities that we want to take a leap with. I want to talk for a minute about bonds, because bonds, as from a portfolio perspective, man, they are supposed to provide some ballast against the declining market. And of course, year to date, we've seen these sharp drops, correction territories for NASDAQ, for S&P 500, and even things like the Toronto Stock Exchange, although it's held much better because of the energy sector primarily, we're seeing these drops. When this happens, historically, a bond component will counter that. And as stocks go down, historically, bonds have maintained or gone up. Well, we're really not seeing that in this time right now. We're seeing a very strong correlation of almost everything going down. In the portfolio, we have two bond funds. We have one in each of the portfolios. In the Questrade portfolio, we have CHB, which is the iShares Higher Yield Index ETF. We also have MUB, which is the Mackenzie Unconstrained Bond Fund in the Wealthsimple account. And if we look at what these funds have done over the last year, yeah, it's been painful. Even the more conservative fund is down 8%. The CHB High Yield Fund is down 12%. So would we have expected something different from these bond funds? Well, probably yes. The reason you have fixed income in a portfolio, like I say, is to provide that downside protection. Well, we haven't seen it. Both of these and a bunch of other fixed income funds have been down sort of in line, you might say, with a lot of the equity ETFs. Quick note on bonds, because a lot of people, I read this all the time, when you're looking at owning a bond and you focus on the price of the bond. Remember, all of these bonds, all of these ETFs will pay a distribution. And so you always need to take the price versus the total return. And just as an example, if we look at XBB, which is one of the iShares, it's the core Canadian Universe Bond ETF, very widely held here in Canada. And if we look back over the last year, we'll see the fund itself is down 15.3%. But that's not factoring in the dividends. So when you factor in the dividends, the fund is still down, but about 13.1%. So substantially or materially less than the actual price itself. So really be aware when you are looking at the bond, you're not only factoring in the price, because that's what you'll see on the quote, but also what's happened in the interim as long as you've held it. And to give a sort of a more concrete example of that, if we look at this XBB fund going back 10 years to 2012, the gap widens. If we look at the fund from a price perspective, is down about 14%, but when you factor in the dividends you've received, the fund is actually up over 14% and stretching it way back to 2002. So looking at a 20-year number, same story. The price itself has been, it's zero, it's flat over that time, but you're up 128% if you factor in the investments, the interest on it. And that's, when you buy a bond fund, when you buy an ETF, you're buying it for that cash flow. You're buying it for the interest. That's the main reason that you're buying, or one of the main reasons you're picking that up. So just keep in mind when you're looking at these quotes and you see this, XBB for 20 years has done nothing. It actually has provided a return. You're not going to see it if you're looking solely at a price. Now, logically, why have bonds dropped so much? Like, what's the disconnect? Why would we have these in the portfolio and they haven't been behaving the way that we've expected them to do? Well, this really comes down to interest rates, and of course, we're all, in the investment field here, we're all sort of aware that the interest rates are going up. If we look at the US 10-year here, currently at about 3.3, if we look back not even a year ago, it was trading down at about 1.2, somewhere in that range. So when interest rates rise dramatically like this, you're going to see there's an inverse relationship. As interest rates rise, the value of a bond goes down. Getting deeper into bonds is a whole other scenario, but just as sort of the purpose of this little talk right here is to try and explain what's happening today in the markets and why bonds aren't doing what we think that they would do. When we look at the Canadian 10-year yield, it's the exact same. If we look at it over the last year, it's basically mirrored the US. And if we look back even, again, over that 20-year time period, you can see that they pretty much work in tandem. So when we look at what's happened over the last year, the orange line on this chart is the XBB, this universal bond fund I was just talking about, and the blue line is that US 10-year yield. So you can see this really dramatic correlation in an inverse manner between, as those interest rates have risen, we've seen the value of that bond go down. Leads to the question, and I'm hearing a lot of this right now, should I even own bonds? Like, gee, what purpose are they serving in the portfolio? Right now, it looks like they're not serving a purpose in the portfolio. But if we look back over history, let's not sort of exclude the history of any type of investment that we have. But if we look back to a recent market crash, when we look back to 2008, 2009, clearly in this particular occasion, bonds held their value during this very volatile time frame. And if you were a heavy equity player back in those days, you surely would have been thankful that you owned these bonds going through a very, very turbulent time like that. Gee, should we have seen that now? Yeah, quite possibly. Things are different when it comes down to how low the interest rates were, and there's all kinds of other factors that go into it. But I would say, despite what's happening today, I wouldn't become disillusioned with owning fixed income. Now, everybody makes their own decision. These are sort of just portfolio managed concepts I'm talking about here today. Generally, fixed income does play a role. Today, it feels pretty crappy if you're owning because it's not doing what they're supposed to be doing. But certainly over a longer term, you would expect that the correlation to work better and more in sync with what we're thinking. Over the last year, we've kind of learned that investing can be pretty rough at times. We're just living that actually literally as I'm doing this video today. Reminder that investing is a marathon and it's not a sprint. Hopefully, the purpose of the series is to help people, give some ideas on how to manage a portfolio. This has been a look at what we're doing here. I have questions. I'm throwing it out there. Looking at what we've done, especially if you've been following the portfolio or the series along, what would you have done differently than what we've done? Investing is always, to me, a collaborative event. It's a collaborative affair. And so I don't think one person can sit there really as effectively and do something by themselves without having ideas to bounce off them. So I'm just throwing that out there. What would you have done differently if you, now, with hindsight, I suppose, what do you feel are the biggest misses that we've made? So whether it's an error of commission, we bought something that went down, or an error of omission, where we bought something or we missed buying something that we could have done better on. Really curious to see what your thoughts are. We're going to continue the series over the coming months and years, so that'll be good. If you want to go and start from the beginning and watch the series over, I will put a link here for that in the just up on the screen here, where you can go back and look at the episodes right from the start through. I really recommend you do that if you're a beginning investor. I will remind you the first link in the description below is for our Investing Academy. I would strongly invite you to check that out if you want to learn more about the programs that we have available. And I would, of course, thank you for watching the video. I hope you found value from it, and I look forward to seeing you in the next video.